How is the economy doing lately? The global economy is experiencing balanced growth while struggling with persistent inflation. In the United States, real GDP growth projections indicate a resilient recovery, though a slight slowdown is anticipated in the coming years due to geopolitical tensions and inflation risks. Globally, inflation is expected to gradually decrease over the next couple of years, with advanced economies showing more significant improvements. Policymakers face the challenge of balancing inflation management with sustaining economic growth, navigating obstacles to ensure sustainable development while addressing inflationary pressures and geopolitical uncertainties. In a newspaper article called Growth Stabilizing but at a Weak Pace, it is explained that the global economy is projected to grow at 2.6% this year, potentially rising to 2.7% in the coming years, despite challenges like high interest rates. Inflation is expected to gradually slow, but interest rates will likely remain elevated. The ECON blog posted by the PIIE discusses global economic projections for 2024. It highlights expectations of continued economic expansion alongside failing inflation rates. The post emphasizes that, despite these positive trends, there remain challenges such as geopolitical tensions and policy adjustments needed to support sustainable growth. A publication by Fred called The Recent Ins and Outs of Unemployment explains that as of August 2024, the U.S. unemployment rate stands at 4.2%, slightly below the historical average but rising from a record low of 3.4% in April of 2023. This is raising concerns about a potential recession. ISLM graph. The IS curve indicates an expected GDP growth of about 2.5% in 2024, while the LM curve reflects stable money supplies unless significant adjustments are needed to address inflation. Currently, inflation is projected to decrease from 6.8% in 2023 to 5.9% in 2024. The LM curve is expected to remain steady initially, but could change based on new inflation control policies. Quantitative evidence. The IMF predicts a gradual decrease in global inflation over the coming years, while U.S. economic growth is expected to show steady recovery before potentially slowing. This outlook reflects economic resilience amid inflation challenges, highlighting the complex balancing act policymakers face between fostering growth and controlling inflation. The situation underscores the need for careful economic management in navigating inflationary pressures and maintaining sustainable development among global uncertainties. Level of the core CPI. The data from October 2023 showed the CPI had a small monthly increase and a larger year-over-year rise, indicating balanced ongoing inflation. The Bureau of Labor Statistics has not yet released figures from October 2024, with this update scheduled for November 2024. These regular reports are essential for policymakers, economists, and businesses to measure economic trends and make informed decisions. Inflation. The US CPI inflation rate for October 2023 is calculated by measuring the year-over-year increase in prices of core consumer goods and services, excluding volatile food and energy costs. This data shows a significant rise over the past year, indicating ongoing inflationary pressures. While excluding certain volatile elements, the core CPI remains a key indicator of overall inflation trends, providing crucial insights for policymakers and economists in assessing the economic landscape. Current level of the real GDP. In the second quarter of 2024, the U.S. economy showed significant growth, with the real GDP rising at a strong annual rate. This increase brought the total value of U.S. goods and services to a new high, reflecting strong economic health and productivity. GDP growth. Recent U.S. economic data shows that GDP growth has been fluctuating rather than steadily declining. The economy expanded moderately in the first quarter of 2024, surpassing initial projections. Growth accelerated in the second quarter, with the GDP increasing at a more vigorous rate. These figures indicate that despite quarter-to-quarter variations, the overall GDP growth trend in 2024 has remained positive. The economy has demonstrated resilience, with the second quarter showing a significant improvement in economic activity compared to the first. Part 2. Forecast. Near-term forecast of economic and financial conditions. Central banks, like the Fed, consider inflation, economic growth, jobs, financial stability, global trends, government spending, and new technologies when making decisions. They use this information to adjust interest rates, aiming to keep prices stable and maximize employment. Where the economy is likely to be headed. The economy faces an uncertain future with several challenges. Core inflation remains a concern, potentially leading to higher interest rates that could reduce consumer spending and investment. While current GDP growth is strong, it may slow due to many factors. The job market is healthy, but rapid wage growth could fuel inflation. Financial markets are at risk if interest rates rise sharply. Global issues and high government debt add to the complexity. Technological changes may disrupt employment patterns. Balancing inflation control with growth support will be crucial for central banks. What changes should be made? Recent FOMC minutes show the federal funds rate will remain high. The Fed is checking job markets, inflation, and global economic trends. They aim to balance growth support with inflation control, ready to adjust if needed. Rate reductions are only expected when inflation is under control. Analysts predict steady rates through early 2024, with changes depending on global and inflation trends. The Fed maintains a cautious, data-driven approach, prioritizing stability while remaining flexible to economic shifts. In this ISLM graph, the IS curve relates interest rates to income levels in the goods market, with higher rates typically reducing investment and income. The LM curve links interest rates to money supply, where higher income increases money demand, raising rates. In this situation, the LM curve is influenced by several factors that affect the money supply and interest rates. Banks' willingness to lend, the federal fund rate set by the central bank, overall economic conditions, inflation expectations, and the regulatory environment all play crucial roles. These factors can either increase or decrease the money supply, shifting the LM curve to the right or to the left, respectively, and consequently affecting interest rates in the economy. When looking at the IS curve, during the Christmas season, the IS curve is primarily influenced by the increased consumer spending, which shifts to the right. Business investment affected by commercial lending and government spending also impacts the curve. Additionally, the economic health of trading partners and currency exchange rates can influence exports and imports, further affecting the IS curve's position. This ISLM diagram illustrates the IS and LM curves and their intersection, indicating the relationship between interest rates. The point where IS and LM curves meet shows the balance in the economy. If people or the government spend more, the IS curve moves right. This pushes interest rates up, making it more expensive for people and businesses to borrow money. Future output. The spot where the curves meet shows how much the economy is making now. If the IS curve moves to the right, it means the economy might grow because businesses are investing more and people are spending more. But if the LM curve moves to the left because the government makes it harder to get money, the economy might slow down in the future. Part 3. Recommendations for Fed funds. Given the current state of the U.S. economy, the Federal Reserve should carefully balance controlling inflation and promoting economic growth when deciding on short-term interest rates. Here are some suggestions for the Federal Open Market Committee regarding the federal funds rate. Current economic situation. Inflation is decreasing but remains above the Fed's 2% goal, with core inflation being a key indicator. The U.S. economy is growing fairly, though concerns about potential slowdowns exist. The job market is strong, with low unemployment and steady growth, but rising wages could potentially contribute to inflation. Policy suggestions. The FOMC may keep current rates to allow inflation to reach its target without impending growth, providing flexibility for future adjustments. They should base decisions on income data, potentially lowering rates if inflation decreases, or raising them if it persists. Clear communication of future plans is crucial to manage market expectations and reduce uncertainty. Risks to watch. The FOMC must consider global issues as geopolitical tensions and trade changes that could impact the U.S. economy and require policy adjustments. Additionally, they need to ensure that any interest rate changes don't lead to excessive market volatility or asset bubbles, keeping overall financial stability. This ISLM graph shows that the economy faces high inflation, prompting potential interest rate hikes by the Fed, which could shift the LM curve upward. While growth and employment remain stable, inflation concerns persist. The Fed may keep current rates, adjusting based on future data. Clear communication is vital for managing expectations. Global issues and rapid rate increases pose risks that could negatively impact the IS curve. Conclusions. This ISLM graph illustrates how the current economic conditions and Fed policies interact, providing insights into the implications for interest rates and future output. The Fed's ability to adjust its monetary policy based on economic data is crucial for managing growth and inflation effectively. These are my recommendations. The Federal Reserve should keep steady interest rates while remaining flexible, as inflation is above target but beginning to ease, allowing for careful tracking without hindering economic growth. Future rate adjustments should be guided by new economic data related to inflation and employment. If inflation continues to decline, the Fed may signal potential rate cuts, while a sustained high inflation rate would need readiness to increase rates. Clear communication is essential for managing market expectations, so the Fed should openly share economic outlook that could affect the economy, including global events. This strategy aims to balance inflation control with economic growth support, considering the strong labor market and moderate GDP growth, allowing the Fed to effectively navigate inflationary pressures and economic slowdowns while pursuing its goals. Thank you.